Welcome back, everyone. So we are busy with our basics for capital gains tax and provisional tax. So in this session, we are going to focus now on the practical aspects of it. So if you guys can follow in your tax workbook, so on page, let's quickly see, page 112, you will find question 7.1. Now, what I've always told you is when we do a question in a test or in an exam, the first thing you need to do is go down to what is required of you. Now, the reason this is important is so that you guys know what information you need to go look out for when you read through the additional information. Now, in this question, they ask you to calculate the taxable capital gain. So that means the portion that we are going to include in our taxable income. So that is the net capital gain multiplied with the inclusion rate. Okay, now because we can see it's a PTY limited, the inclusion rate would be 80% to work out what our taxable capital gain would be. Okay, it's for the 2021 year of assessment, so that means it would run for the 12 months. We'll just check what the year end is for the company itself, and then on the disposal and acquisition of the above assets, and then you may assume the tax legislation remains unchanged. Now, the reason they tell you that is sometimes things will change within the tax periods, which would affect these calculations. But because we only want to test if you understand the basics of taxable capital gain, that's why they've put that in there. Okay, so let's go read through the information that was provided. So they tell you Rock Pty Limited manufactures and sells mining equipment and is not regarded as a small business corporation. Okay, so that means we're just going to apply the normal rules. Okay, as defined in the Income Tax Act and is the year of assessment, the company decides to sell some of its assets on 31st of July, so the same date as the year of the assessment, so when the tax year ends. So that means our tax year would have been from 1 August 2020 up to 31st of July 2021, if we are looking at the 2021 tax year of assessment. Okay, so then they give you the information for 3 different types of assets. We've got our office building, factory building, machine. Then they tell you what is the date of purchase. Not only one asset is prior 1 October 2001. So they will have to go look at the information provided to see what method we are going to apply for their base costs. The other ones are after that, so that would be the original cost price and any allowable expenditure that we incurred that we can add on to that. Then they give you the cost price, so this would be assigned to your base cost. And then your selling price would generally be your proceeds. Okay, so this is before any adjustments. So you just need to be aware of the fact, based on the additional information, do we need to add more information onto these amounts? Okay, so let's go read what they say about the office building. So the office building, which is no longer in use, Rock Pty Limited incurred transfer costs of 180,000 when acquiring the business office, and they are not included in the 1.2 million. So one of the additional expenditure you are allowed to add to your base cost is transfer cost. So we have to add 180K to our base cost. Okay, because it's not included in that an original cost price. Okay, so that means my base cost would increase. They do not give us any other information regarding that, so our selling price, our proceeds would be the same. Okay, because of the fact that this building was already purchased in 2001. We had capital allowances at that stage, but which is no longer applicable. So we would not have to worry about a recoupment as well for the office building as such. Then the next one is our factory building is in the use of process of manufacture and qualify for a Section 13 industrial building allowance. Now, seen as you see there is a building allowance, you need to go think about recoupment. What is the potential recoupment that I would have to include in my gross income? And then that would also affect the proceeds as well as the base cost amount. They tell you the tax value at 31st of July is 382,000. Now the tax value is generally what we use for calculating our recoupment. And then according to the sales agreement, a million will be paid on the 31st of July, and the other 200,000 will be payable end of Jan. Okay, now based on the fact that 200,000 is only paid in the following tax period, will that impact the amount that I use for the proceeds? What do you guys think? Okay, so I'm just going to repeat the question. If they only pay a million in our current tax period and they pay the additional 200,000 in the following tax period, will that impact the amount we use for the proceeds? What do you guys think? Okay, so my question basically is, for when we calculate the factory buildings capital gains, will we use the million or will we use the 1.2 million as the proceeds in our calculation? Okay, so I've got one answer which says a million. Anyone else? Any other takers? What do you guys think? Are we using a million or are we using 1.2 million? Taborka thinks we're using 1.2 million. A million. Okay, so remember the rules for our taxable income or our income is that we do the earlier of receipt or accrual. Now, even though they pay the 200,000 after year end, when we dispose of that asset, that full sales price of 1.2 million accrues to us. So we will actually use the 1.2 million. Okay, so we use the 1.2 million in our question and not only the 1 million. So this is what is important that you know the rules, because otherwise you might use the incorrect amount when you do the calculation. Okay. Let me just move this up so we can just read the rest of the information. Then they tell you we've got legal fees of 75,000 that was incurred in the sale of the building. Now, one of the additional expenses you are allowed to add to the base cost is legal fees. So we add the legal fees of 75K to our base cost amount. Okay, so this is how you are supposed to go through the information and identify where the information goes. Then the next thing we have is the machine that qualifies for Section 12 wear and tear allowance. Okay, and the tax value is nil. So that means we've used it in full. And the market value, here they tell you the market value of the machine on 1 October 2001 was 1,500, and the company wishes to minimize its capital gains liability of the sale of the machine and wants to adopt the market value for the evaluation date value at that date. Okay, so they've decided they want to use the market value when calculating the capital gains tax at that specific date. Then the last bit of information, they tell you that we had an assessed capital loss that we brought forward from the 2020 year, which is 85,000. Okay, so this is the information. How we're going to deal with it when we do the calculation now is we're going to focus on each individual asset and apply the rules to them, and then we are going to consolidate them all together. Okay, so the first item we're going to look at is our office buildings. Now, what we have to do is we have to go work out whether there's any recoupment, but because of when this office building was purchased, there wouldn't be any recoupment because there was no allowance at that stage. So when we do the office building, the first thing you would have to list is you would generally go look at what is the cost of it, which was the 1.2, which was given to us. You can just put the Excel on here for you guys. Just make it a little bit bigger. Okay, so for the office building, the first thing is you go into the cost. Now the cost was 1.25 million, which was given in the question. Then we said based on the additional information, okay, so based on the additional information, we said that there was also a transfer cost of 180,000 that also needs to be included. So I then go add the transfer cost of 180,000 onto the 1.25 million to get to the actual cost of 1.43 million. Okay, so firstly you go work out what was the actual cost of the building. Now we have to determine was there any recoupment. Now what I said is based on the information that we had, there wasn't any allowances because of when this building was erected, so there wouldn't have been allowances, so the tax value when it was sold is still the same amount. We will not reduce it with any allowances when we work out the base cost. Now when we work out the capital gains, we first start with the proceeds. So the proceeds amount based on the information for the office building is 1.5 million. Because there is no recoupment, we do not actually adjust the proceeds amount. So you start with the 1.4 million, 1.5 million for the proceeds. The base cost we take from what is the total tax value when it was sold. And then we work out the capital gain that we've made on this asset is 70,000. Okay, so that is the first asset's capital gain. We made a gain of 70,000. Then if we look at the factory building, let's go read the information again. So the factory building, we know the original cost price was 850. We've also got legal fees of 75,000, which we need to add on to the base cost. But then we've also had a recoupment potentially, and the tax value of that asset is 382,000, which means we need to go work out what was the wear and tear allowance we've already received. when we work this out. So we first start off by calculating the allowances. So we start with the original cost of 850. You only take the original cost. You do not include the legal expenses when you work out the recoupment. Okay, so the legal expenses will generally be incurred on date of sale, so that is only accounted for when we work out the capital gains. Now they've given you the tax value in the question as 382,000, so the balancing figure is 850,000 less the 382,000 will give us a 468, which was the wear and tear allowances. Now what we've said for the question is we need to go look at what was the recoupment, because that would impact our proceeds as well. So now we go look at the recoupment amount. How do we calculate it? We look at what was the proceeds. So what did we sell it for? 1.2 million. But then we have to look at what was the original cost. So for recoupment, we limit it to the original cost. We will never be able to recoup more than what the cost was for, because the wear and tear allowance is based on the cost. Okay, so when we do the recoupment aspect of it, you limit it to the 850, and we deduct the tax value to work out how much has been recouped. So we have actually recouped the allowances that we were allowed to deduct previously in our taxable income. Now that recoupment will be included in your gross income. So let's just write here, included income, just so that you guys know where you would add that information. But now we said for the capital gains tax, we take the proceeds and we have to reduce any amount that's already included in gross income, which is the 468,000. Okay, so we take the 1.2 million and we reduce it by the recoupment amount that we are already taxed on. So our new proceeds is only 732,000. Then the base cost is the 850 plus the 75,000 for the legal cost. And I also reduced the base cost with the allowance, which was previously deducted, which is this 468, to get to the new base cost. And then the gain that we've made on that machine would be 275,000. So it is very important that you understand how to calculate the recoupments, because you would have to adjust both your proceeds as well as your base cost with the amount that has been recouped for any previous wear and tear allowances that was allowed. Okay, now asset number 3, because of the fact that it's pre-October 2001, it is important that you know the rules and you know which value to use. Now, based on the information they've given us, the market value, we do not have the TABC, the time abasement portion cost amount, and the proceeds, we know the proceeds is 500,000, but we would have to go adjust the proceeds amount with any recoupment. That's what I have to include in here as well. So we also have to consider the recoupment based on the Section 12C wear and tear allowance. We would then reduce their proceeds and then work out the 20% of the proceeds on disposal to work out which one of the two is the lower amount to do the calculation. Okay, so the first thing you start off with is we look at what was the pre-October cost. Now the pre-October cost, let's just go back to the question, was 2.5 million. Okay, so that's what we've incurred initially. We did not incur any additional cost after that. Okay, so that means our wear and tear allowances would have been based on the 2.5 million. And because the tax value is 0, we would have used that entire 2.5 million when we did the calculation. Okay, now when we do the recoupment, that would mean we have essentially recouped 2.5 million worth of asset, which is the 5 million, limited to the original cost of 2.5 million. The tax value is 0 currently, so we've recouped 2.5 million. Okay, then we said for the proceeds as well as the base cost, we would then have to go adjusted for any amounts that have been included in gross income. But because of the fact that this asset was acquired prior to 1 October 2001, its base cost would be calculated based on the rules. So we would adjust the proceeds only. So we take the proceeds, which is the 5 million, we deduct the recoupment amount to work out the new proceeds amount of 2.5 million. Now the base cost would be 1.5 million, and how we've calculated that is based on the rules. The valuation date value, because the proceeds of 2.5 exceeds the total cost of 0, whatever the tax value is at that day, we will use the greater of the market value, your time abasement cost method, or 20% of the proceeds. Let's just say proceeds here. Okay, but this is the adjusted proceeds after we have taken into account the amount that has already been included in gross income. Okay, and then you would deduct any cost incurred after 1 October 2001, which was 0. Now, if I work out the 20% of the 2.5 million, I get 500,000. The market value was 1.5. Now, the taxpayer can elect which one of the amounts to use, and they've elected to use the higher one of the two, which was the 1.5 million, to do their capital gains tax calculation. So that means our taxable the capital gain we've made on that amount is 1 million. If we take the proceeds less the base cost, we've made a capital gain of 1 million, which we include then. Then we go work out what is the aggregate capital gain. Which is the 70,000 from the first asset, the 275 from the second asset, and then the 1 million from the third asset, to give me a total aggregate capital gain of 1.345 million. But then if we go back to the question, we've also had an assessed capital loss of 85,000, which I can apply, and I can deduct that from the aggregate capital gain to get the net capital gain of 1.26 million. Okay, but then I said the net capital gain is not what is included in our taxable income amount. We only include 80% for a company to get to our taxable capital gain value of 1,008,000 rand. Okay, so that, let's just put the calculation in here. There's a 1260 times the 80% will give you the taxable capital gain. Okay, so that is how you would do a taxable capital gain calculation. This calculation would generally form part of a bigger calculation of taxable income. Okay, before we move on to provisional tax calculation, do you guys have any questions on what we've done for the taxable capital gain? Are there any questions so far? You can just indicate in the chat function if you're okay with the explanation, or if you've got a question, please type it in the chat function, or you are welcome to raise your hand and then explain it to me on over the mic. Are you guys okay? Okay, then we're going to move on to question 8.1, which is the provisional tax question. Okay, all I want you guys to do before we start is please just change this tax table to 15 November 2020, because normally your tax period you would have had to already do the final payment by that stage. So this is just a typo, so just please change that to 2020, otherwise the suggested solution will not make any sense to you. Okay, so the first thing we do with the question is we go look at what are we required to do. They want you to calculate the first, second, and third provisional tax payment. So in this scenario, you have to do all three of them. Now, as soon as they ask you to do the calculation for first, second, and third, and they provide you with a table like this, it means you would potentially have to use different amounts because of the fact that the information is not recent enough or it has not met the basic requirements. Okay, so you first do first, second, third provisional tax payment for the 2021 tax year end. So that means based on the information that would be end of February based on the year of assessment. Okay, and then they also say provide reasons for amount you decide to base your calculations on. So as soon as they tell you this, you need to explain why you would rather use a different tax year of assessment than the 2021 for some of the provisional tax payments. Okay, so let's see what other information they've provided. They tell you the estimated taxable income for your 2021 year of assessment is 390,000, and then the actual taxable income was 450,000. Okay, so the first thing you had to note here is that our taxable income is less than 1 mil, which will be important when we do the second provisional tax payment calculation. Okay, because that means we have to go look at the basic amount as well as 90% of our actuals when we do the calculation to avoid any penalties. Then if we look at the previous assessments, we'll see we've got 2018, date of assessment was 14 April 2019 for an amount of 362. Then 2019's was submitted 19 August 2020 and for 400,000, and then the 2021 was 15 November 2020, okay, for 500,000. And then they also tell you that included in the 2018 assessment is a taxable capital gain of 62,000, which we will exclude from the basic amount, as this may not be a regular occurrence. Okay, so that's why we generally exclude it from the basic amount, because you might not have a capital sale every year. We would add those specifically. Okay, now let's quickly look at what is the periods for your first, second, and third provisional tax payment. So if we look at the first one, it would run from 1 March 2020 up to 31st of August 2020. Okay, so that's your first provisional tax payment. Your second one would then run from 1 March 2020 up to 28 Feb 2021. I'm going to move this up here so that I've got space here. So that would happen at the end of Feb. And the third one, we would have to submit that information August 2021. Okay, so that's 6 months after our year end. Now, the reason I document this is to show you when you would have done the submission. So the first one we would submit end of August 2020. Now, if we look at the information in the table provided, we've submitted the 2019 one on 19 August 2020. But now we have to go look at what the rules say. The rule says for your first provisional tax payment, you can only use assessments that was submitted more than 14 days before when you have to make the payment. Now, in this case, this is less than 14 days. So that means we will have to use the 2018 tax year for our first provisional tax payment. But that is also more than 12 months as well as 18 months from the date of our payment, or when we're busy with the assessment now, which means I would also have to go and increase that with the 8% to get a more recent basic amount when we do our first provisional tax payment. Okay, so the first thing you would have to note when we do the first provisional tax payment, you firstly have to see when was the company's tax period. Let me just make this a bit bigger. So we first note that the first tax pay or the first provisional tax payment would be the end of August 2020, because our tax period ends at 28 Feb 2021. So the first 6 months would have ended at 31st August 2020. Okay, you actually get a mark for stating that fact. At the payment day, okay, so at payment date, the 2020 tax return has not been received as yet, as we can see. We have submitted the 2019 one, but it is not older than 14 days prior to our payment date. So the 2019 has been received, but it's not 14 days before the payment date, so therefore we can't use it. That is one of the basic rules for the first provisional tax one. So for that reason, we now have to use the 2018 tax return. But what we've said is if that thing is older than 12 months as well as 18 months from our year end, we now have to go adjusted with 8% per annum. So you start with what the basic amount is, and then you go and increase it because of the fact that we are more than the requirements. So now we have to inflate it by 8% per year. So doing that calculation, you start with the basic amount for 2018 with the 362,000. You take out the taxable capital gain. The reason for that is it might not have occurred every year. So you work out what is the adjusted amount excluding the taxable capital gain, which is the 300,000. And then we apply the 8% for the 3 years that has passed now to get it to the correct financial period. So that means, our basic amount is the 372,000, okay, that we are going to use. Let's quickly see what was the actual estimate we did. We had an estimate taxable income for 390,000. Okay, so you can also use the estimate, but generally we would use the lower of the two to minimize the amount of tax we pay rather than the bigger one. So you would take the 372, you would multiply it with the 28% to get to, and then divide it by 2. That amount by 2 to get an amount of 52,080 rand. Okay, so that's the first payment based on the rules. Now, if we move on to the second payment, so let's quickly see what the second payment would be. So we say the second payment would happen on the 28th of Feb 2021. Okay, now we would have already submitted the 2020 tax return because that was submitted 15 November 2020. It's older than 14 days, so we can actually use it. So that would mean we do not have to increase it because it's the most recent one. It's less than 12 months old. So we use the basic amount of 500,000. Now, because we said our taxable income, our actual taxable income is less than $1 million, we will apply the following tax rules. So we said when it's less than $1 million, it's 90% of the actual, or it is the basic amount. Whichever one is the lower of the two, you can apply. Okay, so the basic amount is 500,000, and then our actual is 90% of actual is the 450 times the 90 gives us an amount of 405,000. Okay, so the amount we're going to use is 405. Because of the fact that our assessment is less than 12 months old, we do not have to adjust it for inflation, so it would only be the 405. Okay, so then we work out our tax liability at 28% on that amount, which gives us 113,400. Then I remove out whatever I've paid in the first payment to work out what is still due for the second one. So we deduct the 52,000, so a second payment of 61,320 would still need to be made. Okay, for the second payment. Then the third payment, that would now be based on our actuals. Okay, so the actual amount we've submitted is the 450. I do not adjust it for 90%. I will use the 100% to do the calculation. And then I would remove out the first and the second payment. So you work out the amount payable based on the actuals that was given, 20% or 28%. Then we deduct both the first and the second provisional tax payment. That is based on your calculation. Now, in a test, let's say you've made a mistake here. We would give you a method mark by transferring the amount you've calculated and removing it from the calculation. So once I've deducted the two payments I've already made, the additional payment I would have to make to avoid any interest and penalties would be 12,600 Rand. Okay, and that is how you calculate your first, your second, and your third provisional tax payment. Okay, do you guys have any questions on how to do the provisional tax payments? Are there any questions based on what I've discussed? Yes, now you can put on your mic.
Morning, ma'am. Ma'am, I just wanted to know, with the second provisional tax, do we add the 8%, or is that only for the first?
Now you raised your hand. Do you have a question for me?
Hear me, ma'am? Hello, can you hear me, ma'am?
Yes, I can hear you now.
Okay. I just wanted to know the calculation for the second provisional tax.
Yes.
We don't add the 8%, or we do. Is it only for the first provisional tax?
Okay, so for this
first provisional payment, sorry.
Okay, so it depends on which assessment you are going to use. Now, for the first one, if we just go back to the tables here, because of the fact that the first one is due the 31st of August, and we've only submitted the 2019 one the 19th of August, so it's less than 14 days before when we have to make the payment. The rule says you have to take the previous tax assessment. Now, the previous tax assessment is more than 18 months old. So then, as soon as it's more than 18 months, we have to go adjust it with 8% per annum. Okay, so that's why the first provisional tax payment was based on the 2018 tax year, and we had to go adjust it to get a more representative amount. When we did the second tax payment, it was made on the 28th of February 2021. So we've already submitted the 2020 tax return, so the previous year of assessment, the 15th November 2020. That assessment between the payment when it was made and when we're doing the next payment, it's less than 12 months. So that is seen as if it is recent. So we do not have to go through adjustment. That's why we did not adjust for that. And we've actually used the actual amount in our calculation, which is the actuals after the fact. Okay, so that's why we don't adjust for it. Does that
Thank you,
answer your
ma'am.
question?
Yes. Thank you.
Okay, any other questions? Are the rest of you okay? Do you understand what's happening? Okay, can you just indicate in the chat function if you're okay with the explanations or not? Okay, so that was then provisional tax and capital gains tax, the calculation. So if you do not have any questions, we are done for today. Thank you for your participation. If you've got questions, I'll be online for a few more minutes. You can just type it in the chat function or raise your hand, then I can answer your questions specifically. I will send the recording as well as the slides to the respective lecturers to give you the information. Okay, so then if you've got no further questions, have a lovely day and I'll speak to you guys soon.